New York Community Bank, NYCB, unexpectedly announced a loss of $252 million in its fourth quarter earnings report for 2023, along with a significant dividend cut. This news triggered panic in the market, causing NYCB's stock price to plummet by nearly 40% and dragging down the entire regional banking index. Does this mean the U.S. banking sector is about to enter another crisis? How should we respond? NYCB is among the top 50 savings banks in the United States and is the largest provider of multifamily housing loans in New York State. Founded in 1859 and headquartered in Queens, New York City, NYCB currently operates over 230 branches across 5 states, New York, New Jersey, Florida, Arizona, and Ohio, with total assets exceeding $100 billion. Several landmark events have marked the bank's development history. In December 2022, NYCB acquired Flagstar Bank in an all-stock transaction, making it a wholly-owned subsidiary. The acquisition positioned the bank among the top 25 in the U.S. by asset size. In May 2023, the bank announced the acquisition of certain operations of the troubled Signature Bank for $9.5 billion, including nearly $40 billion in assets and $30 billion in deposits. The acquisition of Signature Bank pushed NYCB's total assets over $100 billion, subjecting it to stricter prudential standards, including risk-based and leverage capital requirements, liquidity standards, overall risk management, and stress testing requirements. Considering this, the bank took action in the fourth quarter of 2023 to strengthen its risk management processes and bolster capital to support its balance sheet. NYCB's recently published financial report showed an unexpected loss of $252 million in the last quarter, whereas analysts had previously expected a profit of $206 million, a loss per share of $0.36, with earnings per share, EPS, turning from profit to loss year-over-year. Additionally, NYCB announced a dividend cut to 5 cents, far below analysts' expectations of maintaining at 17 cents. Affected by the negative news, NYCB's stock price gapped down 42.6% at the open on January 31st, with an early drop of over 46% and closing down 37.67%, marking the largest intraday and closing drop since its IPO in November 1993, far exceeding the bank's largest drop during the 2008 global financial crisis. The main culprit for NYCB's fourth quarter loss was the $552 million in loan loss provisions, far exceeding market expectations, and the previous quarter's $62 million, of which $480 million was for Signature Bank's loans. NYCB stated, the main offset in the fourth quarter was the office loans from the third quarter, given the recent impact of the deterioration in the credit of the office investment portfolio. We believe it is prudent to increase the coverage ratio of the credit loss reserve. Moody's Investors Service stated that it is considering downgrading New York Community Bancorp's credit rating to junk after Wednesday's developments. The deterioration of the U.S. real estate market has also spread to Japanese banks. Aozora Bank in Japan plummeted 21% on Thursday. Aozora Bank announced on March 1 that it might record a consolidated final loss of 28 billion yen for the fiscal year ending March 2024, a reversal from the previous fiscal year's profit of 8.7 billion yen, marking its first quarterly loss in 15 years. Additionally, according to statistics from TREP, by the end of 2025, the U.S. banking industry will face up to $560 billion in commercial real estate debt maturities, accounting for more than half of the total real estate debt maturities during the same period. These developments are undoubtedly a significant blow to the market. However, this does not mean that the mortgage market and banking sector will plunge into the abyss. On the contrary, with the current gradually easing monetary background, the economic fundamentals are good and exceeding expectations. As explained by the New York Bank, this crisis is more about the provision based on financial prudence and a concentrated release of previous crises. After the risk clearance, the market will welcome repair and improvement.